Hello and welcome to eOption. This week is January expiration. It's the biggest option expiration of the year this Friday, and it's primarily because of leap options. What are leap options? Well, we will go in and talk about them. Please take a moment to read our disclaimer. This video is for educational purposes only and should not be considered a recommendation or advice by eOption or myself. So a little history about leaps. Well, first, leaps, what does it stand for? Leaps are long-term equity anticipation securities. They were introduced in 1990, initially exclusively only for stocks. And what it did was it extended options for up to 2 years on equities, both calls and puts, and worked the same as standard options. In the last couple of years, they've now introduced leaps to include both ETFs and indexes. So where did the leaps come about? Initially, options would only trade in one of 3 cycles. As you can see the cycles down below, there was a January, a February, and a March, with the January trading primarily the January, April, July, and October. And then somebody in 1990 decided to introduce the following year, January, going out as far as 2 years for some securities. And now in the last couple of years, they've expanded options on equities to also include weeklies. So here we are this month. The red dot down below represents the Friday expiration of all the leap options and different securities that settle that Friday. Also, this week's big because we have our monthly volatility products and AM settled index options as well in this 3-day period. So at the bottom on the right, you can see when the leaps are added in. So the ones that are expiring this Friday, the 20th, these were introduced way back Monday, September 14th in 2020. So these contracts have been trading for roughly 28 months. This year, there's going to be a new addition. Not only are they going to add the 2026 equity leaps this September, they're also going to introduce 2027 equity leaps as well. So that will mean that for that January in 2027, those leap options will have traded for 40 months. Let's go over some quick definitions before we get into examples. Stock is going to be defined as an equity or the asset. A call option gives you the right to buy that asset or stock at a fixed price, which is the strike price. A put option is the opposite of that. It gives you the right to sell that asset or stock at a fixed price. And then leaps are going to be calls and puts with an expiration that are greater than 1 year. So some of the advantages. One of the biggest advantages is the leap is typically going to be a lower investment cost versus buying a stock outright. There's a defined risk for both calls and puts. This will be very important on the put side when we're comparing it to a short. Leverage, the option will generally move in a greater percentage compared to the underlying equity itself. And lastly, you can sell or exercise anytime prior to up to expiration. Some of the disadvantages. Even though a leap is a long-term option with a year or greater holding period, the option still has an expiration date versus a stock which you can hold indefinitely. Dividends. If you have a call option on a dividend-paying security, you do not receive any dividends. And lastly, leverage, which was also an advantage, can also be equally a disadvantage, because if the option moves against you, it will generally move by a greater percentage as well. So some examples of how to use leaps or add them to your portfolio. You can buy a single stock call leap, so be comparable to buying a long stock. You could buy a single stock put leap, and you would do this if you were considering a stock to go down over the next year or 2 years. It's big advantage over shorting a position because of the defined loss. You could also buy a single stock put leap on a position in your portfolio to maybe lock in the sell price into the following calendar year. And then lastly, you could buy an index or ETF put to hedge your overall portfolio. Maybe you think the market over the next year could have another dip, go back, test the lows. You could offset some of the risk by having a put or two in your account to hedge the portfolio in general. So where would you find your leaps? If you go to our trading platform and you go into option chain, you would type in whatever symbol you're looking for. So in this particular example, I've pulled up Boston beer. And the primary reason I did this is this particular equity, and not all equities are going to even have leaps or options for that matter. This basically has its basic cycle, and it has one January 2024 leap, which I've highlighted in yellow on the bottom right. Now, if you were to compare that to a more heavily traded security, which my next example is Apple, you can see there's way more expiration dates. Not only are there monthly, there are several 5 different weekly strikes. They also have every month covered for the whole calendar year of 2023. And then there's 5 different leaps at the bottom, ranging from January of 2024 all the way out to June of 2025. And it seems like the leaps are now going to be expanding into June as well, as a number of securities have not only January, but a June leap listed. So let's go into our first example. And in this example, we're going to compare the difference between buying 100 shares of Apple with, let's say, buying a 2024 at the money call leap. So if you were to buy 100 shares of Apple, your cash outlay would be roughly close to $13,500, where buying an at the money call for Apple, the defined cost would only be $1,900. So in comparison, technically your max risk on buying 100 shares would be the stock going to zero, even if it's highly unlikely, but your max risk would still be the full 13,000. Your max risk on the Apple option would be the premium you paid, or the 1,900. Now, where the leverage would come into play is, as you see below, I've used our options play tool, which is available on the eOption platform, to set the target price at 165 going out to the next leap expiration in 2024. And the expected profit, if it did reach your target, would be 3,000 on the stock and an expected return of 22%. And then where you see the leverage come into play with the leap option is you've only put 1,900 and your profit's $1,095, but the expected return percentage is 57.5% roughly. So there you can see the advantage of leverage of buying a leap versus buying 100 shares of stock. So in our next example, I'm going to compare a put. And what I'm going to compare it to is, maybe you think certain security is going to go down and you would want to short it. But one of the biggest risks of shorting is the max risk is unlimited. Not only would you need a margin account to short the stock, it leaves you open to unlimited risk. If you were to wanted to put this trade in some sort of cash account, it would just not be, it would not be feasible. You'd not be able to do it because you would need a margin account. So those are the two big things comparing this. If you were to short 100 shares of Tesla, it would cost $12,000. If you were to buy a 1 year at the money leap, it would be just under $2,800. Now, you may have noticed that the leap cost price is a little bit more. The premium on the leap is going to be based on the underlying volatility of the security. So Tesla is deemed a little bit more volatile, so it could cost a little bit more or less depending on which security to buy the premium on that particular leap option. I've set our target price in the bottom at 85. That's our goal for the next year. And the expected profit again for a 100 shares would be $3,700 in this particular example, with an expected return percentage of 30%. And if you were to put the same trade on with the leap and it reached your target price of 85, the expected profit is only $1,000, but that's on a $2,700 investment. And the expected return percentage, again, is going to be higher at 37%. So the last example that I'm going to give is if you were to just maybe buy a put on an underlying ETF such as SPY, which is the S&P 500. There are other ETFs such as DIA for diamonds, which would be the Dow, and QQQ would be the NASDAQ. But this particular example would be buying a leap as sort of a hedge for your portfolio. So in this example, we've bought to open a at the money 400 put. It's actually slightly in the money, about 1.5 points, and costs $2,800. If the market were to fall roughly 10% from where it is now, from let's say 400 to 360 on SPY, the expected profit on that particular trade would be around $1,130 or 39%. And again, one of the advantages of the leaps is the cost versus shorting or buying the securities outright is typically going to be much lower percentage than actually the fully paid for securities. In this particular if you were to short 100 shares of SPY, it would cost you upwards of $40,000, where you're only spending less than $3,000. So it's only about not even 10% of the cost of shorting the stock. So if you want additional resources, please feel free to visit our website, www.eoption.com, for more trading resources. You can also watch more eOption videos. Please make sure to subscribe before you go. And thank you. And also feel free to join our next webinar. You can register for webinars at our website at eoption.com/webinars. Thank you.